All right. Hello, YouTube. This is Signet with the Bullish Bears. I'm going to do a little commercial real quick before we get started. Just let me get my headset reorganized here. All right, a little bit of a commercial. If you're not yet a member of the Bullish Bears, if you haven't come by and tried to sign up for our 14-day trial, you're missing out. It's free, right? You got to love free. I love free. Coupons. I like coupons. So free. You come by, you sign up for the 14-day trial, you get access to the chat room, and we call out trades, not necessarily all the time. We don't just sit in there looking for the next trade and calling it out. It's not really what we do. But during the week, we do get multiple trades put out for our members, not just day trades either, but swing trades as well. And we post them in a private Twitter that is only for our community. But we're also focused on educational content. And me personally, I've spent a lot of time, effort, and energy into developing advanced level options material. I know that doesn't sound very exciting, but see, here was the problem. I was learning options and I would go out and try to Google different option stuff, and I would get this real generic video telling me, oh yeah, this is a call spread, this is a put spread, this is how you want to put on a credit spread or a debit spread, and it would just be these real generic videos, kind of giving me like theory, market theory on options, but not giving me any damn strategy, right? And that doesn't do me any good. I don't need market theory. I need a way to pull the trigger on a trade and know what the outcome is going to be. So I dug deep and I got into back testing. And between Tastyworks and Options Alpha, I was able to develop some really great strategies. So I started making my own videos. And in the next level training library here in the options tab, I made most of these videos. And the video isn't, let me explain what a calendar spread is. The video isn't, oh, well, this is what a strangle is. That wouldn't do anybody any good. These videos are specific entries. What delta to use, why you're using it, how far out in time to go, what rules you would need for the criteria of that trade. Very specific setups, very specific trades. So if you're sitting there and you're thinking, man, I'm going to get into options, but I just can't seem to find any material, it's right here. These are swing trade and day trade strategies that will get you on the right path with consistent wins again and again and again. And while you're at it, you can also go through the educational content and get behind the scenes on why I was able to put this together or how I was able to put this together and learn ways that you can put your own strategies together so that you don't have to rely on the criteria that I've defined in these videos. Right? There is options trading happening around the world. The calls came out in the 70s and the puts came out in the 80s, and it has been back tested and run through the ringer. Millions and billions of dollars has been spent to backtest this stuff. So why try to reinvent the wheel? Find out what the prop firms and the trading companies are doing out there. Why are they consistently profitable? And let's just do what they're doing. Right? It's not rocket science. It's not trying to do something new and exciting. It's just doing what we all already know works. And if you don't know what works and you haven't learned how to do it, come over and get at it. All right, so that's the commercial. I'm done with that. Now let's just get into the market. Is there anything in particular you want to look at before I activate the stream into the rest of the community? Because right now, I'm only streaming to you. I'm only streaming on YouTube. But here in a moment, I'm going to be actually getting into the Bullish Bears trade room, the live stream room, where the rest of the community is at. And once I get in there, I'm not going to look at this chat anymore. I will be streaming to YouTube, but I'm not necessarily going to be paying attention to anything that you have to talk about once I get into that room. So now's your opportunity. Is there any market that you want to look at? Perhaps review back uh, a market today. We were reviewing Beyond Meat a little earlier today. Somebody had taken a swing trade in it, and it wasn't working out for him, obviously. And we kind of just was reviewing it. So, we can look back at some markets that you traded today, maybe something you're interested in trading, and, kind of go from there. No? Okay. Then I'm just going to go ahead and fire up the live stream into the Bullish Bears, and we'll get this afternoon started. Going to take a moment while I activate the audio over there. It's always a little bit of a process. So pardon me a moment. Hello, everybody. I need a sound check here. Orale way. No? It's always no the first time. All right. Reset the sound bar, the audio bridge. And round two. Hello, everybody. Check 1, 2. Check, check. Can you hear me? Hello, Gordon, Vicky, Captain, Alex, Phil. Good afternoon, everybody. This is Signet. Hello, Janet. January 31st, Friday afternoon. A wonderful day in the marketplace. Absolutely amazing. You gotta love a day like this. I was day done before the day even started, and through the day, I have become day done 10 times over. Because when it's a trend day, you just hammer down and get after it and love every moment of it. I've actually been messing with my audio controls because everybody kept telling me they couldn't hear me. So, Brew, I'm happy to hear that you can hear me. Everybody keeps telling me my mic is too quiet, and they've always got to dial it up when I come in. So, maybe I finally got that darn thing working. Maybe. That's awesome. My audio's in the videos that I record is horrible. I'm always dialing it up. I can't hear anything. All right. Wonderful day in the neighborhood. So the other day we were talking swing trades, just regular everyday swing trade tactics. Trade Tactics 101. We're in a strong market, and every single trade that I had closed out eventually with profit because it just kept running and it never looked back. That's kind of good, right? Happy to have some profit. Glad to have been in the trade. And then what? Well, the then what is I couldn't get back in. Nothing was pulling back to offer me an opportunity, or it was pulling back, but it was too close to earnings. Right? So it didn't meet my criteria and I couldn't get into a trade because of it. Well, now we've had this really great pullback in the market. And I'm not trying to imply that it's a great thing that people are getting sick and dying and the virus and all of that. That's not what I'm saying. Obviously that's a horrible situation and we all need to recognize that, people are having a hard time with it. The opportunity that I'm talking about, though, is the opportunity that the market has presented us. For all of those really strong companies that were ripping to the upside, they've pulled back and allowed us an opportunity to get in. One that I would really like to mention is Apple. This thing has been an absolute beast. And when they came out with their earnings, their phone sales, which is something that nobody really was looking at anymore because they had already poo-pooed all over their phone sales. They made it very clear in the last two cycles that, hey, we're moving away from leaning on phone sales, and that we're wanting to get more into the other services. So when their phone sale numbers came out, and it was out the ballpark, this thing should have exploded like a rocket ship, and it didn't, because of the current market situation, which is just fine with me. It was already at highs, and it wasn't offering me a chance to get in. Now we have a chance to get in. I still think that, anything above 310 is still too expensive, but it's better to get in now than it would have been to get in at 327. And if I can get in, say, Monday below 310, that would be even better, but I really don't think we're going to get that opportunity. The point being that right now, you can take advantage of a product like Apple, putting on a very aggressive debit spread, or credit spread in my case, because I would rather take the other side. Run it for a good standard 40, 42 days out, and get a really good value on your trade right now. Right? $5 wide is kind of my sweet spot. I don't like to go too far beyond that. 2.25 credit. Hey, that's not bad at all. Right? What am I risking in this trade? Well, it's $5 wide, and I've got 225. The other side would be 275, because we need to form a box. Right? These credit spreads, they're just one side of a very large box. And if it's $5 wide in the trade, and I've got, say, 250 in credit, if I've got half the $5, where's the other half of the five, right? So 2.25, that's not bad. And I'm going 42 days out, and the question becomes, do I think Apple can get back above 312.5 between now and Mar 13? Well, that's not a really big ask, right? I'm not asking too much out of the market for that. I could try to even get a little more aggressive and say the 315, 310. That doesn't really give me more money though, right? I now need $2 more in the market, and I only got another 13 cents for it. And nah, I think I'll go back to the other one. I like the other one better, right? So we could throw an order in, something like this, throw it in the market, and we're not asking for too much. It just needs to hold above 312.5. That's it. As it holds above 312.5, the premium decay is going to take the value out of this trade. We're the seller, so we have to buy it back to close, which means the cheaper we buy it back, the better. If this thing goes all the way to zero and I have to spend no money to buy it back, I will happily buy it back for no money. That means I get to keep all the credit. Okay? So every day that the market goes and stays above this value, and the time decay comes in and it sucks the life out of this option, we buy it back and we close the trade for profit. This is one trade out of many trades, out of many styles and strategies and tactics when it comes to trading options. They're not universal. You don't rubber stamp all of them the same way. They need to be handled according to what your goal is, what your level of risk is, your stomach for risk, how long you want to be in the trade. All of those things become a piece of the discussion in determining the kind of options trade that you're going to take. And there's not a quote wrong way to do it, but there are ways that are more effective than others. Right? So I used to use that language. I used to say, "Hey man, that's wrong. Don't do that. You're doing it all wrong." That's not the way to look at it. It's not about what's right or what's wrong. It's about what is your goal and what is your tactic and your strategy. So a typical average everyday strategy when it comes to trading options with the credit spread is to trade aggressive or neutral. And aggressive means exactly like what it sounds. You're expecting the market to make a damn move. And I mean, like, damn, that's a move. If you're not expecting that kind of move, you don't want to go aggressive. If you can't get that move in the time frame that you're looking at, you don't want to go aggressive. And instead, you want to take a more neutral stance, right? You want to go bullish neutral or bearish neutral. And I know that that sign kind of sounds like an oxymoron, right? You're either neutral or you're not neutral. But that's not necessarily how it works. Suppose I'm bullish, but I don't know how bullish. Say like Apple. I'm bullish in Apple, but we are in a pullback because of this virus, and I don't know how long that pullback is going to last. So I'm bullish, but I'm not expecting a big move in Apple in the next 2 weeks, for an example. Well, then I would be neutral bullish. I would want to build the position where I'm not asking the market to give me anything. And that's the difference. If you're taking an aggressive trade, you need the market to do something. You have an ask in there. I need this. If I don't get this, I'm going to lose. But if you're taking a neutral position, even if it's bullish neutral or bearish neutral, you're building the position and you're saying, I don't need nothing from you. Stay the hell away from me. You go do your thing and don't come anywhere near my trade. It's a lot easier to figure out where the market shouldn't be than trying to figure out where the market's going. If you take an options trade directionally, which is what most people try to do with options, you have to get 3 things right. And if you get any of the 3 wrong, just one, you're going to lose. So you have to get direction. And I know that doesn't sound too hard, right? Can't be that hard to freaking pick direction. Wall Street doesn't pick direction. They don't bother. You got to get the timing right. Not just the direction, but when is it going to go in that direction? And then you've got to get the distance right. Suppose you do know that it's going to go up. How far up is it going to go? Because if it only goes up a little bit, that might not be enough. Maybe you need more. So you need those 3 combined. Direction, timing, distance. You get any of these 3 wrong, you're losing. That sucks. I don't like to lose. It's not even about the money, really. It's I don't want to lose. I don't like to lose. So, putting on a directional trade is hard, and it's where most people fail. But they don't fail because they get one of these 3 wrong. This is the funniest part of all. They fail because their expectations are too high. And me being a psychology major, we got this really unique phrase that we say a lot. And we just kind of apply it to people all the time. Unrealistic expectations. That's what causes every bit of grief in your life. From trading to driving down the road to buying groceries to eating dinner. Unrealistic expectations. That's it. That causes loss more than anything else. So, directional trading is not as hard as it sounds. The only thing you have to do is dial back your expectations. You have to prove that your strategy is going to work. Whatever the strategy is, you have to prove it. Now, you can prove it on paper, and the whole time you wouldn't be getting ahead at all. You wouldn't be gaining anything, but you would be learning, right? So maybe there's that silent, sweet spot that you get to learn while you go. But paper is only going to get you so far. You got to go live. If you build a strategy, whatever the strategy, and you aim for 10% profit, and I know I can hear the gnashing of teeth and the crying and the hair pulling already. 10% profit, and you shut the trade down, you're going to have a very high win rate. Market fluctuation alone says that 10% profit is going to help you close out trades even when you got the direction wrong, because the market will pull back as it's moving away from you and laughing and accidentally help you hit 10% profit. Okay? So 10% is just a good place to start. If you put on 50 trades in the next month and closed them out at 10% profit, you would probably have a really high win rate, even if you have no freaking clue how to do technical analysis. Even if you've never seen charts before and today's your first week and you're going to go in and start trading directionally, you would probably still have a pretty high win rate. As long as you understand how to build the options spread so that you're not shooting yourself in the foot. Because if you grab the wrong Greeks, if you grab the wrong strikes, if you build the trade incorrectly, you're screwed. It doesn't matter how much you have the direction right. It doesn't matter how quickly you plan to shut it down. If you built it wrong and it was just a bad journaling comes into play. So if we're closing down 10% profit, we need some rules to start developing what it is that we're going to do. Day trade, swing trade, scalping, doesn't matter. Whatever it is, we need some rules. The easiest rules to start with are the things that we absolutely don't want to do. So maybe some no-go rules. What could you see on the chart to say, oh, hell no, I ain't trading that? Something that has earnings, maybe? You see that earnings is going to be coming up within your options window, and you decide, nope, I heard those Greeks are second tiered, and I don't want to screw around with that. So move on to the next product. Maybe you bring up a chart and you see that it has gone parabolic lately. And you decide, nope, not trading that. Maybe you get out there and you see that it has a history of gapping all over the place. It gaps up, it gaps down, it gaps with no rhyme or reason. Probably want to avoid that. So that's a good place to start. You weed those three out, you're headed in the right direction. And then maybe you got some monetary value, right? Maybe you don't want to trade anything cheaper than $50. Right? We're trading things that are in options, so something less than $50 might not have options Greeks that you want to trade. You could use 20, you could use $10, whatever your limit. You probably don't want to trade options on something that's $3, right? It probably has really horrible options, and you'd want to stay away from it. But whatever you decide, having some limit on the value of the product that you're going to trade. Liquidity would probably be a good place to start. So if it has weeklies, and then the other side of liquidity, if it has a decent share volume, and Thinkorswim defaults to one of those. By the way, it's like 100,000 volume with a 50-day moving average, right? So that's not too hard to figure out. And just by using these simple criteria right there, we can weed out a lot of crap because there's over 4,000 markets. We got to try to figure out what we don't want to trade. We get those out of the way, and then whatever's left, we can start to narrow that field down and develop a trade. So we got some no-go rules. That's a good place to start. Then we need to figure out what we're trading. We need to find something to trade, which means we need to have a pretty good idea of the strategy we're going to be using. We could use something as simple as breaking above support, breaking back through resistance, maintaining a sideways position, any of those three. All right, when you see a market break below support and then break back above it, maybe that's a trigger to go long. Or a market has been sideways and it breaks above resistance to the upside. Maybe there's a reason to go long. Whatever trigger that you want to use, you could also use it to name your strategy. So break out from support on a daily. And now, when you trade the strategy, you would journal it, and you could just say, I traded a breakout from support today, and blah, blah, blah. How do you exit early on an iron condor? Glad you asked. So here on the Bullish Bears Next Level Training Library, Golden Nuggets, exit orders for debit spreads, credit spreads, and iron condors. The video is for doing it automatically, but what it's really showing is how to exit the trade. It's a 3 to 5 minute video showing you how on Thinkorswim to put in your exit early. And the idea behind that is you sold that iron condor and you need to buy it back. Hopefully, you're buying it back cheaper than you sold it. So perhaps you sold it for $1.05 and you're buying it back for 52 cents, right? And so you're getting around 50% profit. Golden nuggets, automatic orders, iron condors. That way. You like it. So this stuff, this is the behind the scenes boring stuff, but this is how you slowly and consistently develop a trading plan, a trading strategy. And it might be difficult to find something with a scan that broke below support and is coming back above it. That might be something specifically hard to scan for. But we can scan things that broke below its 20, right? Or broke below and came back above the 20, or something like that, right? We could use 20 for the scan. It'd be possible to do, right? But more than likely, it's going to have to be some kind of hunt and peck that you go to a known list, a watch list that you keep, and you quickly scan through it at night looking for things that are in a range and have broke below it. And then you set your alert, you put it on the watch list, and when the market breaks back above the support that it had failed, that would be your trigger, and then you would go and take the trade. It's just one example out of a lot of different ways to do things. Certainly not the best way, and I'm sure I could think of ones that are way worse. But it's having a plan based on price action and understanding why this particular trade would be a trade worth taking, and then developing that trade with the right options to effectively and consistently build profitable trades. Now, I used to be a kind of person who loved indicators. I loved them so much that I started coding my own because I wanted to tweak the colors, or I wanted to add clouds and labels. Oh my goodness, I loved labels. Well, to code an indicator, you got to know what the indicator is doing. And so I had to go in and I had to learn all about these different indicators so that I could understand what it was that they were doing. And the more I was using them and learning about them and reading about them, I realized that they were developed when most people didn't even have computers. That they were done on paper and a pencil with a calculator, and people were drawing out their charts and they were drawing out the signals on the indicators. I promise you, this is the way things used to be done. They weren't on a 5-minute chart. They couldn't have done the formula fast enough for the 5-minute chart. By the time they got done drawing it, they'd be right back into recalculating it. They were doing it on a 4-hour, maybe a 2-hour if they hired some new guys and they were just wanting to get them with some grunt work, and they would just throw those at them, keep them pushing the calculator all day long. But otherwise, they were running them on daily and weekly and monthly, and they were pretty good for the time because they didn't have this. They didn't have a computer. They couldn't just bring up a chart and look at it. Those indicators are so antiquated and they're so backwards compared to what we do today that they're almost worthless. Completely and utterly worthless. And that you get no value from them. And that they're actually harmful. Okay? They're bad for you. Because if you're looking at the indicator and you're trying to perform technical analysis on the MACD, you're not looking at the one critical piece of the chart, the candles. If you perform technical analysis on the price action and not on the indicator, you will get a lot farther in life. And that doesn't mean you can't use the indicators. But remember that they're training wheels. Those indicators are supposed to help you transition from not knowing anything about the market to being able to read the market. So perform technical analysis on the chart, confirm what you believe by looking at the indicator after you're done and see if it agrees with you. Because what you won't find in an indicator is forward guidance, anticipation. You can't. It's looking completely behind you. Imagine trying to steer your car by looking in the rearview mirror and knowing when to turn. You're going to miss your turn every single time. Yeah, there you go. That's probably exactly right. I mean, the market's been around since before plumbing, indoor plumbing and electricity. The market's been around since before the United States existed. The market is as old as time. People have been buying and selling and trading things. There are pictures of the stone pits where people used to gather and meet up on the stone benches with the big center stone platform in the middle of it. And that was the marketplace. So it's not the idea that I'm just trying to poo-poo all over the indicators. It's the fact that they're extinct and that they're misleading and they're completely and utterly holding you back. They're weights around your feet, tangling you up and misleading you. And if you would just strip your chart down to this and get your old trusty drawing tools out, you would have a lot better success. So let's suppose that we just ignore all of our best instinct and we use an indicator. Let's use one that nobody ever talks about. What the heck are warning symbols? Barbara Starr developed an indicator based on the MACD. It focuses specifically on trending and momentum properties. It analyzes the MACD in relation to the zero level, which produces important trading signals. In addition to MACD analysis, this indicator displays warning signals, hence the name, based on the behavior of the price plot in relation to the moving averages. No kidding. Hey, they've even got a predictive filter. Get out of here. All right, well, let's play with that warning symbols. You know that there's a strategy out there for anything. for literally anything. Any indicator that you could find, somebody made a strategy for it. And they're probably killing it with that strategy. We could try to analyze SNX, but not from the perspective of the unusual options, because I haven't done a lot of work on trying to determine what a trading firm is doing or a prop trader. And remember, they can hide their trades from you. They can. And if you're spotting the trades, or if Black Box Stocks or Trade Flash spotted their trade, it's because they wanted you to see their trade. So you got to kind of keep that in mind. Like, why do they want me to know what they're doing? Are they trying to entice me into taking a trade? So options, time, and sales, SNX. We got the mass quantities up here, the biggest trades. There's the 10 biggest trades. And we can see the put spread here, the 330, 335. We got the call spread, the 45.50. Another one, the 45.50. And then we have these two, oddly enough. Probably in relation, you got to put them with the numbers. Well, those were all four together. Huh. See the time period on these. Get my pen out. All of those right there. So every single one of these calls were all done right there in blue at the same time. So break that down a moment. We had 190 145s, and then another 60 145s, and then another 43 145s. And that puts it above these 150s. There's more 145s than 150s. Unless another set of calls came in a little lower than this and it just didn't pop up because of the condition that I set. So there's 250 150 calls and almost 300 of the 145 calls. What were they doing? And look at the time frame for that last set of calls. That might be completely different. That might not have anything to do with it. We can just go to these four here. That would make more sense. So that's 250 in a spread. The 145, 150. Mar 20s. It's out of the money, so you'd have to try to think that they're doing some kind of credit spread, right? Because who would build an out of the money debit? I say something like that, but then, there probably is somebody out there saying, I think I'm going to go put me an out of the money credit debit spread on there. I see it happen all the time. But let's just go ahead and assume, love that word, that they know what the heck they're doing and that they put this trade on right here. They're expecting the market to stay below 145. It's a bearish trade. And they took 250 of them. They're risking $90,000. In buying power, it's going to take them $63,000 to $600. Volume is quantity. That's what I'm looking at, the quantity of the trade. What do you mean even higher? The focus of the trade is that somebody came in here and plopped down that much money in risk to take this trade. Who cares about the random yahoos that added to the position since then? We already knew that it was even higher because look at these other quantities. There's 2, there's 2, there's 2, there's 40, there's 30. If you want to trade this kind of stuff, you better go watch the classes that Black Box Stocks has done. They teach sweeps and blocks and what it is when you see these orders and how you can take advantage of it and how you can try to determine what it's signaling. You're not going to get it from me in some 10-minute stream. It's weeks if you are diligent, weeks just to understand each one of those terms: blocks, sweeps, playing into the unusual options activity. That is, if you actually want to be a pro at this. If this is what you want to focus on, set aside the next 2 months of your calendar and get in here and study it. Me, I did not want to do that. I swear to God, I didn't want to do it. So I didn't because I don't trade that way. So I'm like, blocks and sweeps, I got an idea of what they are. I get it. Can I trade it because of an alert? Nope, I cannot. Because I didn't take the time to go in and learn it and master it. Because this doesn't meet my criteria. It doesn't have weeklies. It's some junk company that I know nothing about. I'm not trading this thing. And I'm not going to trade anything else that pops up on there just because it's got blocks or sweeps or unusual options activity. None of those things meet my criteria, so I don't trade it. But here's the cool part. You can, right? That's cool as hell. You can. You can go in there and build a strategy and master it. And they're killing it every week. I can't take that away from them even in the slightest. Every week, these guys are calling out trade alerts that hit 1,000% profit. They do it all the time. So if you want to day trade options on these alerts, even if you're going to use the free stuff, Trade Flash from Thinkorswim, you could still get some free education from Black Box Stocks because they've done all the work. But don't think for a moment that you can half-ass it and be successful at it, because you can't. Here's Creed's video, which I've shared before, but repetition, repetition, repetition. And you search Black Box Stocks, you will find over 100 hours of educational content that they've created. Over 100 hours. Plenty of material to help you become a master at blocks and sweeps and unusual options activity. And then you need to reconfigure your entire Thinkorswim and get your hotkeys set up and develop muscle memory. Learn how to write the bracket orders or basket orders or OCO orders so that you can take advantage of this style of trading. And if all of that just sounds too overwhelming, which is what it sounded like to me, since I've already got plenty of ways to be profitable other than going through that mess, I said, thanks, but no thanks. I'm just going to skip it. Hey, you swing trade. Let's jump over and take a look at that. Oh man, this thing is, because that is just a mess. All right, that's better. Okay, so say you're looking at the market and your question, entry strategy when you're looking at a market that is at support or resistance levels. Well, first glance of the day, you can see this had a good strong trend all the way down, and it has broke the trend, right? We could also have put on the 50 moving average, and we could see that that has also been broken. And now we've got something sitting in the box. And you got to be the person who decides, are you looking for a market that's going to fail and come back inside the box, or are you looking for a market that's going to break out of the box? Now, this thing is tired, right? It's made a hell of a move today, and we're getting ready to start the weekend, so nobody's looking to swing this into the overnight. You could try to trade a breakout, or you could just try to trade what the market has already established for you, that there is a high and a low, and until you have a reason to expect otherwise, this is just going to maintain that high and low. At that point, you choose and you pull the trigger. There's no wrong here. There's a 50-50 chance that this is going to go up and a 50-50 chance that it's going to go down. Now, you could say, well, it's depending on the time frame that you're on, it's creating a bull flag here, and it's got the channel, and it looks like it's getting ready to break up to the next level, and that could go into the 1 minute, maybe put a Fibonacci on it. Okay, then go long. Now, me, I don't like to trade more than 3 contracts, right? I could start with 1 contract. Say I put my order in at 34. Now, I don't have my order flow up, but I'm looking at 34 because it's this smaller level of support. And I could look to go long there. Just got filled. Why? Well, I guess I was short the whole time. Let me flatten the trade and go long from 34. I was running the drills earlier, and I guess I left a trade on. Thank goodness for paper, huh? So if I was to go long from 34, I'm long now. I'm willing to give this a little bit of heat, right? So say I'm looking at this and I think, well, I've got the box defined. I'm looking for a breakout. I'm in at the 34. Where would I draw a line in the sand and say, well, I was wrong? If it breaks below 32, I would be really concerned, right? Because we had a little bit of support here at the 32, and so that would be a good place to draw a line in the sand and say, man, if it breaks below 32, we're coming back down to the bottom of this box again, in which case I have no business being long. So between now and 32, I could try to average down if I start taking heat. I'm not a big fan of averaging down, but that's something you could choose to do. Or you could just stick with your one long and say, my line in the sand is 32 because of this other area of support. And that if it breaks that, then I could say, I have no business being long in this trade because it really looks like we're headed back down to the bottom again, and get out of the trade. What I've found that people are unwilling to accept the trade as a loss, unwilling to close the trade because they think, well, it's going to come back around and I'm going to be right eventually. I just got to stick it out. And so what happens is they stay in a trade and they take heat 10 points against them, and then it finally comes back and they get out with a tiny bit of scratch, and they're like, oh, thank goodness I didn't take that 10-point loss. When if you'd have just bailed out of the trade, you could have wrote it down 10 points, made profit, and then wrote it back up again and made profit. Yeah, you can add pivots and you can add yesterday's high, yesterday's low, yesterday's close, the Globex high, Globex low, Globex close, which would be the regular trading hours open. You could do all of that, and they would help, right? The idea is, if I'm looking at a market that is pushing the top of its range, what do I do with it? Well, you make the decision and pull the trigger. It's okay to be wrong, right? If absolutely nobody knows what's going to happen in the future, nobody can predict direction. No indicator can either, right? So there's no magic thing out there that says, I promise this is going to go up, pull the trigger. I promise it's going to go down, pull the trigger. And since we know that that doesn't exist, we can just choose. I'm going to go long here. Okay, I'm taking heat. I think I was wrong. Time to get out of this trade. Get out, look for another entry. But people don't do that. Instead, they stay in it. Oh, it's going to come back around. I'm gonna just average down from 32 because the bottom's down here. Just own it. Now, one way that I've helped myself own things is to talk it out. I talk to myself. Most of the time, I listen to myself too, but not always. But I talk to myself. So I get my drawing tools out and I draw all over my charts. And if I'm getting ready to get in the trade, I ask myself, all right, look, I'm gonna get in at 34. That looks like it's just consolidating here and it's about to pop. You can see how we were getting these lower highs and lower highs and lower highs, and yet the bottom wasn't falling out of it. The bottom was holding and holding and holding right there. And so I said to myself, hey, this 34 is looking good, right? It's compressing, compressing, compressing. I'm gonna go long here. Well, if that's what I'm looking at and I get in and it dumps like this, I need to get out of the trade, right? It didn't do what I thought it was going to do. It might eventually come back around and do what I thought it was going to do, but that wasn't the trade. The trade was, I think this is getting ready to pop. I got this compression coming in. It looks good for a long. I'm going long. If that didn't happen, close the trade. And while you're also at it, you could say, well, it it broke to the downside. I was wrong. I'm going to get out, and it could be headed back down to this lower level. Sweet. I guess I'll just go short. I've got a target in mind. I can front run that 27 down there. There is there is no indicator or thing out there that's going to give you uh, that guaranteed result that you're looking for. There is none. And staying too long in trades, that um, what what problem I struggled with the most was getting out too soon. And that was hard to deal with because I'd get out and the market would keep running, but Gordon hit it exactly on the nose. Who cares what the market does after I get out? Did I hit my goal? And so when I started focusing more on that and not focusing on what I left behind, it was all in my head, right? Happy I got a trade. Happy that I followed the rules of my trade because a trader has a plan and trades it. Someone who's not a trader just jumps into the market willy nilly and reacts to their fear and their gut and their greed. The drills would be a really great way to help anybody who's day trading. And it doesn't matter what you're day trading. You could be day trading shares or options or futures or options on futures. It doesn't matter. Those that cut and reverse drill, that thing is a great way to help you become a better trader. It is hard to walk away from a bad trade. And usually because as soon as we get out, it turns around and goes in the direction we wanted it to go. And then we're sitting there saying, see, if I'd have just stayed in it, it wouldn't have turned out. I wouldn't have had that loss. And we teach ourselves this bad habit of waiting for it to come back around. And literally, we teach ourselves that bad habit. And if you spend the time and the effort of unlearning it, it does get easier. And then you can get to the point where it's no longer a problem. But it still sneaks up on you sometimes. Still sneaks up on me sometimes. So I got in. I wasn't really particular about where I got in or how I got in, but I'm in. I'm short one. Set the quantity to 2. Now, if you're doing with this with shares, you could set the quantity to like 100, right? So that you're long or you're short 100 shares, and then you set this quantity to 200, and that would get you out of the 100 that you're in and flip you around to 100 in the other direction, right? And if it's contracts of options contracts, just, one is more than fine. You can put options in this chain so you can do it the same way, right? And the goal there is just to ride the price action. Now, eventually, hopefully, you would get to a point where you don't need a chart at all. That you're not even looking at the chart. You're only looking at order flow. But man, we all got to start somewhere. So if we can start with looking at the candles in doing this, and then we work our way over to not having the candles eventually, right? Then we're getting there. But think about this. Those prop firms are hiring brand new kids right out of college who've never seen a chart. And they give them this drill. And they don't give them a chart either when they give them the drill. They give them the drill with no chart. And if you think it's hard, that's because it's showing you that you've got a long ways to go. If you go over and you start doing this drill and you find it really easy, then hey, that's awesome. That means you're a lot more advanced than you probably thought you were. Wait, that's the wrong side. So if you find it really easy, then great. You're farther ahead than you thought. Man, this paper is a laggy bugger. That's why I've been just staying with the Trade of 8 when I want to paper trade these drills. Come on. There it goes. I don't know how I got the gradient effect. I would have bet it's because of the setup. So if you go into application settings and you go to look and feel, I am under old school toss, and you're probably not in old school toss. You're probably in dark or light. So I haven't spent a lot of time on this drill because I'm still working through the first one. This is drill number 2 and I'm still on drill number 1. But I have done it enough to be able to record a couple videos, and I'd already started to pick up on a time frame differential that's kind of interesting. That if you are running it on a 1 minute and you're going through and you're chasing the whip, and you could put it on like a 133 if you wanted to and just get all wild and crazy with it. But you start backing away and getting into the higher time frames, you're not running whipsaw all over the place in here, right? You're not reversing directions like crazy, and you're actually taking uh, points of trade one direction and then another and then back again. Points instead of just, oh, I got 3 ticks to the upside, 3 ticks to the downside, 5 ticks to the upside, 2 ticks down. You're actually getting 6 to 8 points in one direction, and then you're flipping over and running the other direction consistently and profitably. I can't imagine how those and I don't run ticks, so it's kind of a hunt and peck. Yeah. But you literally just stay in it and keep trading the trend and, until it reverses, and then you trade the trend in the other direction. So go in there, give it some time, and if you find it hard to do, keep doing it. If day trading is your future, get it. This is an ugly mess to trade. The trend is clear though. Can't argue with that. When it comes to ETFs, I'm a pretty big fan of the market gauge ETFs. I don't know if any of you have spent much time watching stockcharts.com and their TV series that they have, the free TV, but they cover a lot of Dow theory and market breadth studies, and they look at kind of the broader market, and they analyze sectors in the market to determine market strength, bias. It, it's just a lot of market theory, I guess, is just the best way to say it. And if you're a member of Stock Charts and you go to their website, they got these chart packages that you can buy that bottles up these different industries and sectors, and it's interesting stuff. And there's a company called Market Gauge that sends out a free email every night that looks at these sectors here. And they made it like super simple for people that know, I like absolutely nothing about the market. And so they got like granddaddy this and aunt and uncle and like the kids, and they turned it into a family, and they just tell a story every day about these sectors. And if that just sounds completely silly to you, then you've grown to the point where you probably already know your sectors, and you know what areas of the economy that these are dealing with and why they're looking at them. And if you don't, then hey, there's always that. And there is sectors for dummies, spiders for dummies too. And I like those dummy books because sometimes they just take a lot of information and condense it for you really quick and make it easy to see what's going on. I've kind of tagged on this before, but if you're going to look at VIX, and if you're going to trade volatility products, you're probably not going to want to use the TVIX. The TVIX is not going to give you a perspective of the volatility inside the marketplace. It's not going to give you any tradable intelligence or information or actionable material. You wouldn't want to rely on that for any kind of grasp about how much the volatility in the marketplace has gone up or if there is, quote, fear in the market. That is not the product that you want to use. And if you're looking to actually trade on volatility, you probably don't want to use that either. The TVIX is made by Credit Suisse, so they own it, just like the spiders are made by SPDRS, right? It's a company. So TVIX is owned by Credit Suisse. And when I was out learning about volatility, I was looking at the different volatility products out there, and I came across how the TVIX works. And I'll share the link if you want to go read about it. Credit Suisse hires market participants. They're called authorized participants, APs. And those APs are paid to manipulate the price of the TVIX. If they believe that the price is outside of its boundaries of where they think it should be, these people can go in and massively buy it or massively sell it to dump the direction one way or the other to get it, quote, back in line with where they think it should be. So it's a 100% manipulated product. And they don't try to hide that. It's not like I'm wearing a tinfoil hat and talking nonsense. They publish that information very clearly and very cleanly. And they said, oh, they're bragging about it. Hey, don't worry. If this thing gets out of line, we got guys that'll go in there and clean it up. Well, what the hell? Thanks, but no thanks. I'm not trading that. All right. So then using that for any kind of volatility gauge, well, that won't work, right? Because if it's not reacting to what's happening in the marketplace, then it's not a marketplace gauge of fear and volatility. So we can't use it for that. Well, what about trading it? Surely we could trade it, right? I mean, we could trade anything. So how about we trade it instead? If you were looking at my chart a moment ago, I had VIX. VIX is something that has a bottom because we're never not going to have volatility in the market. So sure, it gets into the lows, and there's actually a recorded low, the lowest it had ever gone, but it's never going to zero because we're never not going to have volatility, right? And so it's a product that has a bottom, and it has not yet proven that there's a top, but it's got a pretty decent high for a top. Definitely has a bottom. And it doesn't reset itself at night. This does. Another problem with this, if we're going to try to trade it, is we don't know what it is. We don't know what it's calculated on. We don't know what formula it is. Remember, volatility is not a thing that we can trade. It's a formula that we're trading. So the VIX, that's the volatility of a 30-day SPX option. 1892 is the price right now in the VIX, 1892. If we jump over to the SPX and we go to the options and we look 30 days out, the implied volatility should be pretty close to 1832. Come on, Thinkorswim. It's pretty darn close. It's a little off, and I don't know if that's because I'm on paper or why it's a little off, but it's a little off. But that formula for the VIX comes from the bid-ask spread and the implied volatility of the SPX. That's literally the entire reason for its existence. So we know the formula for this thing. When we know what it's measuring, we can go check it. And then we know what the implied volatility is for the VIX. And that might sound kind of funny, right? I mean, we can see the implied volatility of SPY. How come we can't see the implied volatility of the VIX? Well, you can. You go to the VVIX. That is the implied volatility of the VIX. When implied volatility goes up, it's usually because the market product is going down, or vice versa. Well, when the VIX goes up, it's because the SPX is going down. So what does it mean when the implied volatility of the VIX goes up? That what? That the VIX is getting volatile? That its expected move is getting bigger? All of this we understand and we know, and we can go read books about it. It's at one website. You can go to like the CBOE, and they've got a ton of material on implied volatility, how it's calculated, why it's calculated the way that it is, why they've changed the formula 3 times in the last 2 decades. And all of this is easy to grasp with a little bit of effort. Would you get into those double and triple leveraged products, or you get into something like the TVIX, then you got to ask the question, if this thing is on a continual trend to nothing, how come I can't just go in here and buy a put and ride it all the way to zero? Because it resets every night. It recalculates itself every evening after close. And then during the day, it's a manipulated product, no less. So you can't get any market perspective for fear, and you can't trade it. So the hell do we do with it? We just leave it alone, and we go find something that will give us some perspective on volatility, and we leave it alone, and we go trade something that is tradable. This ain't tradable. If you want to scalp it on an intraday basis, sure. Competing against those market participants can't be any worse than competing against the algorithms. So on an intraday basis, look at the trend on that thing. That's beautiful, clean price action. Sure, go in and trade it. Day trade it. What do you guys think? Breakout or breakdown? Is this a head fake here? Looks like it's getting ready to set a new high a day, which it just did. Are we looking for a breakout, fake out? Pull the trigger, go to new highs. It just hit a roundy. Or trade the reversal. Looks like it was a reversal. All right, a little bit of homework. Got to jump over to the live stream on the YouTube, since I had been ignoring them momentarily. Do 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 do. All right, YouTube, I am going to be shutting down the live stream over here, If you didn't hear the commercial earlier, come on by, join up for your 14 days, and come into the trade room. Welcome to the Bullish Bears community.